Hey, fellow traders. In this video, I want to try to touch on a rarely discussed topic, and that's discretionary trading. It's probably one of the better forms of trading that you can do. This doesn't rely on just a set of one or two different things or just one or two different little methods. It's a way that not very many people talk about, and I feel like that might be because it's one of the harder concepts to teach. But I know I've done a lot of thinking about how I actually trade because this is the way I have primarily tried to focus on learning to trade and how I try to make most of my trades. And I think I may have come up with a way to try to work this out to where I can maybe teach it for you to learn discretionary trading too. If it's your first time visiting the channel, just make sure to leave a subscribe and a like on the video if you find value and information in what you're getting. And for those already subscribed, welcome back. Let's go ahead and get into the topic of the video. Now, it's going to be broken down just like the hedging video series is, but unlike hedging, this one's going to be not so related from one idea to the next, but it is going to be one of those things where you kind of learn some basics and then kind of get into more advanced things. For this video, we're going to first just start out with the bare bones minimum, and that's basically taking a look at how the market moves, the order flow, and the simple of it. So basically, why does the price move? What makes it move? How does it move? And how does all those work together to create the price chart and get the candle formations or whichever chart style that you have set up, the Hakanashi or a line chart or however it is. Then we're going to take a look at one of the most basic and most commonly used forms of taking trades, determining a market turning point, trying to figure out when maybe a pullback might be over, those kind of things. And then it's going to go a little bit further by looking at the relevance of support and resistance, because not all support and resistance is created equal. Some forms of resistance are going to be stronger than others, and then time is also going to play a role in how strong and reliable that resistance level may be. Then I'm going to get a little bit deeper into market movement. We're going to take a look at the fractal market theory, and I'm going to try to expand upon this and really kind of speak about how this really works in the overall flow of the price in the market from one time frame to the next. And speaking of time frames, we're going to finish up everything by looking at the time frames themselves and try to shed some light on why one time frame alone is not really the most reliable, but at the same time, all the time frames are related due to this fractal market theory. So we're going to take a little bit of a look at that. So let's go ahead and get into it. First thing we're going to take a look at is just the basic market movement. And it's a little bit more than just, okay, the price went up, the price went down. We're going to look a little bit more at why the price did what it did. And in order to do that, we have to first take a look at the basic pattern of the market. This is going to be no matter which time frame, direction, so on and so forth. You're going to have various different aspects of price movement, and it's going to result in some type of pattern that is going to be fairly consistent along every path that you take. So basically, the way you have the basic market theory, we've got of course, our Dow theory, our Elliott wave theory, so on and so forth. But we're going to look at it in a little bit simpler form than that. As soon as I can find like a pencil or something like that, I'll be good to go. That'll work. But basically, all markets, all pairs, stocks, indexes, forex, so on and so forth, they're going to follow the same theory. And the first part is you have what I call an event and then a move. An event and then a move. Then there's going to be times where you have events. They may not look like events, but they're going to be events, because this right here is going to happen at a smaller scale at a much faster pace. But then you have your move, your event, and your move. So you're going to always be following this pattern of move, event, move, event, move, event, move, event, move, event, and so on and so forth. This is always going to happen. So by understanding that, then we can get a little bit deeper into the order flow part. And all order flow is just a balance. You have your simple balance of price, and that's the amount of people that are actually looking to sell and the amount of people that are actually looking to buy, plus the orders that are coming into the market, and so on and so forth. But you have your basic balance point in the center. So when you have an excess number of sells in the market and there's not as many buys, then of course that balance is going to go to the sell side and it's going to start basically pushing things down and cause the price itself to go down. So that would mean that the balance is like a seesaw, so it's going to push the price down. But then once it finds the balance again, then you're going to start having one of these events. So in this case right here, we had more buys than sells. So there was a buy imbalance in the market. It brought the price up. It started to find balance where there were fewer people that were willing to buy, but there are still others attempting to sell for the reversal, so the orders balance out. But then what happened during this event is the sellers started to outbalance the buyers. So the sellers, in effect, started pushing this price down. Once the market rebalanced and found an equal number of buy and sells, now we have to go to the event phase again, and we have to get the balance. We have to shift out of balance in order to create another move. So in this case, the sellers created more orders for selling than buying. The price went down, and eventually sellers stopped wanting to sell. And then all of a sudden, price made the event and erupted back here. This event right here is going to be a large amount of orders. You're going to find this a lot of times at the bottom of your very long wicks, which is why I like to use my wicks, the points of the wicks, for support and resistance a lot of times, because those are usually very strong events, and they did not last very long because despite price coming down, there was a far greater number of orders at this level than there were actual sellers, and it immediately turned price back around. And then buyers saw this, maybe a pattern, so on and so forth, that kept the event going until eventually there were no more buyers left, or the buyers were starting to burn out, and then the price found balance again, and then the sellers come back in and took over and created the event to shift the price back down. So you're going to notice this pattern in just about every pair, everything that you trade. And here in just a second, I'm going to take a look at some actual price action, and we're going to take a look at basically how all of this is starting to go together. Let me, get rid of all that. We don't need that anymore. So right here, what I have is the most common pair that I'm usually trading, and that's the Euro USD. Right now, it's just on the hourly chart. It's one of the ones I usually start my analysis with, but at the same time, you have to understand that these hours, this is going to be price action over several points of time in the day, but we have the same basic theory going on. So right now, at this point, so we can just take a look and start back here. You can notice that the price came down a little bit, started to balance, got more sells, continued to get more sells, but then down here we have a large amount of buy orders. So that then in turn pushed the price up. Buyers kind of took a break for a second, price settled. We have our event where buyers built back in, pushed the price up, and then as the price continued, you can see that people were still interested in buying. There was a large number of buys here to continue pushing the price upwards, and eventually it just overpowered and got one more push. And now here at the top, the buyers are starting to run out. Then you start to get a strong push of the sellers by that pin bar candle there. I'm not sure why not wanting to work with me. Easy way. And it won't even delete with middle mouse button. That's kind of strange. Alright. But let me zoom in a little bit so we can take a look at what's going on a little bit better. And I'll change the candle color as well. Sorry for that. Take care of this real quick so that everything looks good and visible. Okay, so carrying on with what we were looking at, there is the large imbalance of sellers starting to come into the market. There were definitely no buyers to continue pushing it higher, so the price went down. We start to get another event, large imbalance to push the price down. Eventually the selling power started to run out. Then we continue on and build in, and then we start having another event, a quick event where a lot of orders were in place, pushed it back up, but so the other group of buyers were not interested, so the price continued to make the little events here to make an imbalance to push it down even further. So we have that move, event, little move, event, big move, and then we could probably even consider this whole little area still part of the move as price is continuing down. It's not really consolidating too much, but you're going to find that same basic idea all the way throughout. So move, event, move, event, move, event, move. So I think you're getting the idea there of the move event pattern. So basically, you're going to look for that pattern to happen, and just because it's already happening for the past event does not mean the future event is going to do the same thing. So just keep that in mind. See, we moved up, made the event, continued moving up, made some smaller events, but continued moving up. Now we have an event in the opposite direction. Now we have the event that builds in the opposite direction to put it down. Now we're starting to get some other events down here to push the price back up, some more events, and then an overpower of balance there to start pushing price back up again. So by keeping that in mind, as we go to the next part of discretionary trading, that will help you understand that the market can turn at any point and why. And the more you start to look directly at these events for what they are, you'll start to see little patterns in these over time, and you'll start to recognize, okay, certain little aspects of how the candles are forming, such as you have strong moves at first and now things are starting to get sluggish and slow down. Those are usually indications that buyers, for example, right here are piling in and starting to build in and eventually start to overpower the sellers. And whenever price is starting to reverse, you're basically looking for the other side from the last trend to lose interest. So just keep that in mind moving forward. And then let me get rid of this. This does not work the same as it does on the website. Okay. And now we're going to keep that in mind when we're looking at the support and resistance part of things. Now, this is one of the most common forms of any type of beginning trade. You're going to notice that even when you're looking at different strategies, like if you're using the 21 death cross strategy, if you're using like an RSI and stochastic combination strategy, or any of your other indicator strategies, another thing would be the Fibonacci strategies. Everything is based out of support and resistance. So, like for example, if you're familiar with the Fibonacci, a lot of times when you're trying to discern Fibonacci patterns and use Fibonacci for the case of actually looking at different levels and whether or not the Fibonacci is valid, that will help you. That'll be one of the primary things that you're looking at to line it up. So let me see if I can get this one lined up properly to work the way we kind of need it to. So that way you know that it's a valid Fibonacci setup and the price will react and relate to that based on the events. So if I'm going back to look at one of the most basic ways that I'm trading, I'm not really using a Fibonacci. I'm more or less just using my horizontal lines. And some people will refer to this as zebra lines or zebra trading. It doesn't really have a whole lot of predictive power per se, but it can definitely help you in managing the risk and also taking a look at where a price might potentially turn, react, or respect. So this is going to be one of the primary ways of looking at your market and what's happening with your events. And notice how as we go back, those levels tend to line up, get respected, but they're not so much all the way through and through towards the backside. So the further we go back, the less relevant the current levels are going to be. So this is what I was referring to in the introduction when we were talking about the relevance of support and resistance. So one thing to try to keep in mind when you're trying to use support and resistance, especially as like an entry or trade type tool, you're going to want to really pay attention to just the most recent price action. I know a lot of common knowledge is to go way back, pull up the daily and for example, take a look at like major levels. Some strategies may start at the daily and work their way down with levels. But the thing is, because of order flow, these levels are not going to quite be as relevant. I know a real common theory, like for example, when you see the strong moves like right here, it's a common theory to believe that there's a lot of orders sitting there. But because you had an extended period of time pass, of course, news changed, and after about 90 days, the conditions were different from when that order was put in. So, of course, it kind of respected it a little bit, but then blew right through it. Like, especially at this level here on the daily chart, there's a strong event here. So a lot of traders will look at this and say, okay, there's probably a lot of orders still sitting here waiting to be filled. But then when price went there, suddenly it just went right through it, didn't respect it at all. And that's because of that time factor of waiting for upwards of 120 or so days, 130 some days before price finally got back there. So in that amount of time, you can have a lot of events change, a lot of things could happen, world events could happen, any number of things could happen over that period of time. So that is not always the most reliable way of looking at it. But if you're looking at more of what's happening recently, notice how in this consolidation of the daily, the levels are a little bit more respectable to what's going on before. They're a lot closer and lined up to what's happening. We could see a wick right here, and it lined up and ended up being support there, so that ended up being fairly reliable. But then looking back here, they start to get skewed and off. It worked about right there, but in the rest of the times, everything is a little off, and that's because over time, these levels will start to shift and change. So just keep in mind that the older the actual point is for the resistance that you're using, the less likely it is to be a reliable point. So it's very likely that when price does finally decide to push back up through this level, it could very well use this level and come back a little bit. But as far as this level goes, it could just blow right through it and not even pay attention to it being there. Just because of the fact that we're looking, even though it's still part of the same uh, relevant time frame, we're also looking at a long time period since price was actually there. So those orders that are in theory still waiting to sell are more than likely not waiting there anymore because of how long ago that price was used, that level was used to make that rejection. So that's one of the things that you'll learn over time. One of the biggest things about discretionary trading is experience, and that's one of the things I've learned from my experience. So now, as we're looking at that, we understand the basic levels and how they work, the different respect of variance and relevance of how recently they were. So just remember that the more recent that data is, the stronger and more reliable it's likely to be and work as an actual level. So right here, we may actually be a little bit short. You can notice right here that price respected it a little bit. Let's see, that's probably more accurate and closer to the level. Price kind of sat on it for a second like a shelf and then pushed up. So that could be an indication of a possible level. It's also lining up with the wick there. So that's going to notice how that is real close together and relevant, as well as right here, versus when we go back and try to find another point, they're not quite lining up exactly. So um, just always remember that when you're looking at support and resistance. That's oftentimes why I'm not really going back very far or really looking much higher than the last few days. The further back you go, the wider the range of the zone it is more likely to be. So now that we've taken a look at that, we have our basic idea of a fractal market. The way that is commonly understood is that what it's doing at a higher time frame, it will also do at a lower time frame. But it goes just a little bit deeper than that when you're really looking at it in terms of price action. So if I'm going to take and, for example, let's just kind of analyze what's going on in here. So we'll just take a look at this little area where it's square, consolidated. We didn't really have a lot of action. So on a higher time frame, this might be looked at as consolidation. But then when we move down into the lower time frames, we can notice it has different aspects to it now. So it's a little bit different in what's actually happening. So now this isn't really in terms of respect to the actual time frame being used. Now it's not consolidation. It's a constant reversing trend. So there's not really very short time periods where we have consolidation. You may have a little consolidation here, a little consolidation here. That, in a way, could be consolidation. That's slowing the momentum from the drop. You have a little consolidation here. So this is really where the fractal market theory plays a big role in trying to use the higher time frame ideas in order to make an analysis, and this is really where higher time frame analysis really shines, is the understanding that the more you zoom in, the more you're going to have different variances, but the market will still do the same thing. So this is why oftentimes you'll see the question asked, or you'll see people talk about, okay, so if this is on the hourly, you just do the same thing on the 5 minute or the 15 minute. You're just going to use smaller targets and smaller things. And that is correct to an extent. But one thing that you have to keep in mind is that whenever you're going down, the action of what's going on this chart is going to be more relevant than is going to be more relevant to the 15-minute chart than it's going to be to the hourly. The 30-minute chart is going to be more the 30-minute chart is going to be above the 15, and they're going to rely on the next level up. Now, the 1 and 4, I wouldn't really so much say relies on each other so much. It's just a more acceptable convention, but you can look up to 2 hours, 4 hours, 6 hours, 8 hours, and oftentimes I'll see 10 and 12 hours also used. It's just not as widely used or as common. But one thing to note, that even though, for example, we're on the hourly, so this is how I would say when you're looking at discretion for your hourly, let's say you had like a trend line, for example, here, and if price had not been there yet, so let's say we were back at this area here and looking at it as a trend line, and the way I normally will set up the trend line is I will use the break or the change of momentum to start the actual trend line itself, and then take it to the lowest point or the highest point or the next relevant point where we have an actual event that's kind of elongated a little bit. These little sharp points like this I don't tend to rely on too much, because a lot of times they will be false signals in a way. But as we're moving forward, one second. Okay, as we're trying to move forward, I'm not even going to do the replay now at that point. But as we're moving forward, that trend line off of the hourly caused a move in the 15-minute. So we tried to break, we had a fake breakout, and then we started getting events and caused movements and reactions to the 15-minute. So now if we start breaking that down further, get it in the right spot, we'll have a little break right there. We'll start using that as the trend line. Now we're starting to get a little bit of divergence, get a little bit of a pushback off of that line, but then we'll move that forward and look at this in itself as its own trend line. That would be a break and close, so that would be a short. So it gets deeper and deeper that way, but it goes down in time frame. So your higher time frame is going to cause the influence in your lower time frame. Your lower time frame is not going to affect your higher time frames as much, and the reason being is because there is a lot more money actually moving the market in this period of time. There's also a lot more time per candle, so that gives you a lot of time for money to actually enter the market. So, in regards to order flow, one thing to go a little bit deeper into that is to understand ticks. So this is one way that I like to really start looking for who's buying big and who is just entering the market, who is making sluggish price movements, so on and so forth. But on average, what it takes to understand how big a tick is, if we're looking at just one simple pip of movement, so on the Euro USD, that's going to be, from 108.416 to 108.426. That would be one pip. And on average, I believe it takes 1 million in actual currency exchange order to actually move the price one pip. So by knowing that, you can know that if you're starting to see some very large ticks that are starting to push to the upside and very slow ticks coming back to the downside, that will show you that there's a big fish trying to buy the market, and it would be vice versa for looking for a short. So if we were in this area here and notice how price was kind of moving up slowly. It probably crept up the whole length of the candle, and then towards this level here, you probably had a large tick push the price back down, and then it slowly crept back up, and then a large tick back down. That would be an early sign. So if you're on a shorter time frame, like the 5 or the 1 minute, or even 15-minute, you can watch how far these candles are getting shoved in each direction. And a lot of times that'll, especially in areas like this where things are really tight, it looks like it may do one thing or another. I would imagine there were probably some larger ticks in this candle, and in these couple of candles here, the ticks to buy were larger than the ticks to sell. Now it'll look like there's a lot more sell orders coming into the market because you may have it, kind of inch down and move down a handful of times, and then you have just one big push to snap it back up. A couple of more little inch down, inch down, inch down, and then one snap up. So we can actually look at that now as the current price action's going on. If I can get my tool to cooperate. And we can just observe that right now. So we can notice that we're starting to get some down ticks. We have a small level. I'll put a line on that. So we have a small level there, and we'll see, we can just observe how the ticks are actually reacting to that level. And this is a relevant support level. It's a pretty clear area where it was resistance. Then we had the breaks, so that's another way we can kind of use that to give us a heads up that that may be a potential level. So when price breaks above, that would be the likely test zone right there. Now, if we start to break below that, we could actually see price go down even further. And as I'm looking at the ticks, I notice it seems like there are larger sell ticks than buy ticks. So we'll give it just a little bit more time to see if it's going to break through this level or if it's actually going to hold. Now, if I'm looking back a little bit further, this is on the 1 minute. I'll go a little bit higher up so we can get a little bit more strength and relevancy. Yeah, see a very large tick. So we're going to start going down and heading down to break this level and potentially continue on. So what I might look for next for a potential reversal, just being a discretionary form, this might be one level. And we'll mark that. Doesn't really line up going further back. We're more right there in that little range. But with the large ticks, I would probably start to short that. Another thing I would be looking at is this overall little curve right here. Curves are actually pretty useful when you're starting to look at where potential sellers may be coming into the market versus potential buyers. So now I'm expecting we may have a fallout all the way down to this level. So and then maybe potentially reverse from there. So right now I'm still looking at price potentially reversing, but for it being Friday, we could see price go a little bit further if you're trading that Euro USD. Still kind of looking at a potential reverse because if I'm using some past experience, I know oftentimes I will see a trend line get broken, and then as it retraces, it will typically retrace back to that level and then start to reverse down again. But I would expect with this pattern here that if prices start moving back up, we should see price start to come back up even further, and that would be off of a double pattern, long-term pattern that is a pretty common pattern in the market. So oftentimes that'll cause a lot of buyers to come into the market just by simply seeing that double bottom. So they'll be trading that pattern. So as you're looking to try to make your decision on what you may want to do, if you want to enter here, if you want to wait for price to go there, if you want to scalp short, you can kind of consider these recent events Now, if price were to break below and go even further, then you may want to start to consider momentum and look at various different trend lines and how far things are going. And then, for example, wait on one of these type of events here where you're getting a lot more volatility, break in the motion. It's going up really strong and not really going down very hard, and price starts to slow down. That's usually one of the key signs that it's time to enter the market, is when it's slowing down. You never really want to jump into a trade when you're starting to see these very large strong candles one way or another. Usually by the time you've had this candle close, for example, if you didn't catch it up here, then more than likely that move is a majority of the way gone. So by using your event move logic for uh, looking at the way the market is going, you could have actually probably even taken an entry up here, because you could notice the strong rejection off the top of this level here, and that would have given you a much better risk reward ratio by using discretionary trading, instead of waiting for a close of a breakout and then maybe missing the entry here. Because once you start getting into that area there, now your reward ratio suffers greatly. So that's one of the advantages to being discretionary. You can look at the actual event before the move, and based on how much you've actually seen that type of price action before, like for example, you're noticing when we were talking about before the curve. So if you were to look at that curve of resistance, you can notice right here that you're starting to get that curve. Price is trying to go above it, but constantly rejecting. So that would tell you that it's probably a good idea that you could probably go short somewhere in here or even here once it starts to close below that line, and still end up getting a far greater risk reward ratio. So that's one of the biggest advantages to actually being a discretionary trader. And I think that is probably going to wrap things up when we're taking a look at the basics of being discretionary. So far, right now, I've got 2 other videos planned, and I'm still kind of working on the list and trying to make sure that I'm getting all the basic ideas covered. I've got a few other things that I'm also looking at with trying to optimize my current hybrid hedging strategy, with using the stop loss style and compound style trading to try to make sure the losses get recovered. Just making a few adjustments and playing with those. There's still a lot of variables involved. I think R ratio probably will play a small portion, and it may actually be related to the actual loss rate. I'm kind of finding a formula for that. So a lot of different things in the works right now, but I'm going to try to keep some videos coming. I think talking about discretionary trading is going to be a good topic to cover while I'm working through some of these other optimizations for my current strategy and way of actually trading. But I'm going to wrap things up for this video. Again, if you found any value in it, if you like what you see, just leave a thumb and subscribe for more, because like I said, I have at least 2 videos planned so far, and this is just the beginning of the series of lessons in discretion. And there may be a few more, but that's going to do it for this one. I'll see you next time.